We think the worst is yet to come, with further weakness in the third and fourth quarters and probably a recession in 2017. Sebastien Marlier, The Economist Intelligence Unit. Second quarter preliminary GDP figures for the UK will be out on Wednesday. These figures are highly anticipated despite being based on the economic situation mainly before the Brexit vote. With this in mind, Sebastien, do you think these figures will be indicative of the current state of the UK economy?
Well, I actually think that the economy is in a weaker state than Q2 figures would suggest. We expect economic growth to slow to 0.3% quarter on quarter from 0.4% in Q1. And of course, the uncertainty in the run-up to the referendum weighed on economic activity, but we think that the worst is yet to come, with further weakness in the third and fourth quarters and probably a recession in 2017. And there are already signs that this uncertainty from the UK's vote to leave the EU is depressing economic activity. We've had high-frequency indicators showing negative consumer sentiment, falling corporate spending intentions, house price expectations are falling. So all this will feed into later GDP data that will become apparent in future months.
Another highly anticipated event, which is also on Wednesday, is the US Federal Reserve interest rate decision. Post-Brexit, the likelihood of an interest rate hike was slim. However, after strong data from non-farm payrolls and additional positive economic figures, the chance of a rate change has increased. What is your prediction?
My prediction is that the Fed will not move this month. In fact, at the EIU, we don't expect the Fed to raise interest rates until next year, when we expect 2 interest rate increases. And the main reason for this is, as you said, the Brexit vote. So the global uncertainty in financial markets in the wake of Brexit, we think will force the Fed to hold. And it's true that the Fed has typically set policy mostly according to domestic conditions, taking into account inflation in the labor market. But the current fragile global climate is just too much of a risk, and it will be forced to adopt a more dovish stance. And also, if you look at the domestic factors, you have to remember that the June strong labor numbers came after a very weak month of May. So overall, the situation is pretty balanced, and we think that the global factors will prevail this month.
Focusing on Germany, we have unemployment data out on Thursday. Figures from the largest European economy can always have a great impact on the markets. And now, after Brexit, traders are watching even closer. Firstly, do you believe the employment rate will stay at its lowest level in 35 years? And secondly, do you think markets will react strongly from the data?
Yes, so on the first question, I think that unemployment is relatively likely to stay near these record lows. And a few reasons for this is that mainly a number of other indicators have remained relatively positive throughout the month of June. If you look at the market purchasing managers indices, they point to a mixed performance, but with a very strong improvement in manufacturing. There's also been an improvement in business and consumer sentiment in Germany in the month of June. So overall, a number of data is looking relatively positive, and we think that unemployment will follow this trend. And whether markets will respond to this, I think they probably won't as much as they would do in other circumstances. They, of course, are looking for any indicators of the impact of Brexit. But again, the June numbers were mostly from before the referendum. So we will need to wait for probably another month to get a better understanding of how the Brexit vote is impacting the German economy.
Thank you for sharing your insight with us today, Sebastien. That's all for today's Week Ahead, but there's plenty more to come from the Dukascopy TV team, so make sure you stay tuned.